Assalamualaikum warahmatullahi wabarakatuh and good morning. In the last video, we looked at how organizations record their purchases. Now we will look into how organizations record their sales. Okay, and this will be shown to be under the perpetual inventory system. We will look at how sales is done under the periodic inventory system later. Okay, so under the perpetual inventory system, sales revenue is also similar to service revenue is recorded when the performance obligation is satisfied. Okay, so when the seller has actually sent out the items, well, depending on the FOB, whether it's the FOB destination or FOB shipping point. Okay, then once that shipping is arranged or done, then the performance obligation has been done, and therefore the seller is able to recognize the transaction as a sale, okay, as a revenue. Okay, the supporting document for that, for sale, is the invoice issued by the seller. So when the seller issues an invoice after the items have been shipped, therefore the seller can recognize this as a sale, okay, and update their accounts accordingly. Okay, so whenever a sale happens, then there are two set of journal entries that needs to be done. One is regarding the revenue, and the other is regarding the matching of the expense. Okay, like we mentioned earlier, in the perpetual inventory system, the matching account, the matching expenses, is updated immediately after each sale. Okay, so therefore there needs to be two transactions, two journal recordings. The one for the sale, and one is the expense associated to that sale. Okay, so when there's a sale, we will debit cash or accounts receivable, depending on whether the sale is done in cash or in credit. Okay, by a certain amount, and then we will credit sales revenue. Sales revenue is a revenue account. It has a credit balance. Therefore, when we want to increase our sales, we need to credit our sales account. Okay, and the second part is that we need to update our expense account. The expense account that matches our sales revenue is the cost of goods sold. This is our expense account. Okay, so whenever there's a sale, there must be an expense associated to the sale, which is the cost of goods sold. So therefore, we need to debit cost of goods sold, which is an expense account, and we need to credit inventory, because we need to update our inventory account, showing that there's a reduction in our inventory. Why is there a reduction? When we have done a sale, we are removing our inventory from our warehouse. Okay, we are removing the item from our warehouse, and we are sending the item to our customer. Therefore, we do not have that inventory anymore. That's why we need to credit our inventory to update our inventory account, that the reduction in our inventory due to the sale. Let's see a specific example. PW Audio Supplies, again, Audio Supply is the seller. So audio supplies, PW Audio Supply sold 3,800 worth of items to Suk Stereo on May 4 on account, and that amount of sale has a cost of 2,400 in the eyes of PW Audio Supply. So on May 4, there are two sets of transactions that need to be recorded. One is the sale transaction, and the other is the cost of goods sold transaction. Okay, all coming from the same sale transaction. Okay, two types of recordings for the same transaction. First is the sales. So we need to debit accounts receivable for 3,800 because the sale is on account, is a credit sale. Therefore, we debit our accounts receivable account. And then we credit our revenue account, which is the sales revenue, by 3,800. Okay. And then we need to record in terms of the cost of goods sold to match our expense against our revenue. So we need to debit cost of goods sold by 2,400, which is the cost for the sale. And then we need to debit our inventory account by 2,400 because our inventory has reduced by 2,400. Take note that there's a difference in the figures between inventory or cost of goods sold with the accounts received with the sales revenue. Why is it different? Because a company sells item at profit. Okay, so the amount, the selling value usually is higher than the cost. If the sale value is always the same as the cost, then why do people make business? Because they won't get any profit from that. That is why there's a difference between sales revenue and the cost associated to the revenue. The difference, 1,400, is the profit gained by PW Audio Supply from the sale of the item to Suk Stereo. Okay, so there should always be some difference. Usually the sale will be higher than the cost. Okay, otherwise people won't make business. Okay, so there are some issues regarding to sales. Similar to purchases, it's not as simple as a purchase and everything's done, but there's some issues there. So in terms of sales, there are also cases where the customer returns the items, and the seller needs to make sales returns or allowance. Okay, so it's just saying here that this is the flip side of purchase returns and allowance. Okay, so it's just the opposite. The other party is making a purchase return, but this party, okay, the seller will regard it as a sales return and allowance. And it is a contra revenue account to sales revenue. Okay, so whenever the seller receives some items from the buyer because of a return, then we do not reduce it from the sales revenue account, but instead we make a contra account. Why do we not reduce it directly from the sales account? Because there's an important information that comes from sales return. Okay, when we keep our sales returns account, there's a specific recording showing that there must be something wrong with our business that we are keep getting a sales return. Whereas if sales returns we immediately deduct from the sales revenue, then we don't have anything to show in terms of sales return. Then we don't have something to investigate about. Whereas we know that there's some problem going on. Okay. Let's see an example. Okay, in the accounts of PW Audio Supply, when they receive items returned, so there will be a sales return amounting to 300. Okay, 300 of the selling price, and assuming that the cost of that 300 sales is 140. Again, for sales return, it is a contra to sales. Similarly, the accounting records should also show the same. There should be two sets of recording. One for the sales return specifically, and secondly for updating the inventory as well as the cost of goods sold. Okay. So the first is that we debit sales return and allowance. So sales return and allowance is opposite from sales. Okay, therefore the recording is also opposite. Therefore we debit our sales and returns allowance by $300, and we debit our accounts receivable. We are reducing the amount owing by our customer. Okay, our customer used to own 3,800, but because they return some items, we need to reduce their owing by 300. And then the second set of transaction, what we need to do is we need to debit inventory by 140, and we need to credit cost of goods sold by 140. Why do we need to debit inventory? Because our customer returned our items. So now when they return our items that we sold to them, our inventory level will increase, will increase back, because now we have the items back. Therefore, we need to add to our inventory by debiting our inventory account by $140. But then we need to reduce our cost of goods sold. Why do we need to reduce our cost of goods sold? Because remember, every time we make a sale, we need to match that with our expense, and cost of goods sold is an expense to sale. But now, because we have a sales return, so there is a reduction in our sale. Therefore, our expense need to also be reduced. So we need to reduce our cost of goods sold by 140. Assume that the items were returned but were defective. Okay, if the items were defective, then we should not increase our inventory account by the same amount, because when it is defective, then there's the value of the item is much reduced because of the defectiveness. Okay, because it's not working properly. Okay, the item has some errors. Okay, so we should not debit the same amount in our inventory, but we are also given the information that it has a scrap value of 50, meaning that when we receive the item back from our customer, what we can obtain from that amount is only 50, not 150. Because of the defect, we can only obtain $50 out of that item. Therefore, we only increase our inventory by $50, because we can only gain that amount from that inventory. Okay, so we debit our inventory by $50, and we credit our cost of goods sold also by $50.